Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. And Billy, we're also joined by another esteemed guest today.
We're very lucky to have Bruce Williams on the podcast. Bruce is a portfolio manager, executive director and co-founder of Elston. Elston is a specialist Australian equity fund manager that helps us at 360 and our clients help construct portfolios. Bruce's role includes portfolio construction and management, supervision, development and feedback of the research process. We're very, very lucky to have Bruce on the podcast today. Bruce, welcome and thank you for joining us.
Thanks very much for having me. Glad to be here.
Awesome to have you on. Bruce has helped us a lot in our business and helped us make some good investment decisions in sort of how how his team has seen the market. And so here today, Bruce is going to talk a little bit around what's happening in the economy, where things are at. We're just talking before the actual podcast started around how much is going on and sort of the amount of noise that there is that's happening around the world and sort of impacting markets.
Well, I think that's probably a pretty good place to start. Bruce, I mean, over to you. What's going on? What are we seeing both locally and overseas? There's a lot happening. The Middle East seems to be in a bit of a mess. Where are we at? What can we expect?
Well, I mean, it's really where you want to start. Probably if we start right at the beginning, so we go back prior to the Middle East, it really is or has been all about inflation and interest rates. We think the central banks are winning the fight against inflation, but it's going to be stickier or it's going to be harder to bring down than what was previously expected. So if you think the genesis way back when was during COVID, it was a supply shortfall. So ultimately you had ultra loose monetary policy, you had ultra loose fiscal policy, and people went out and spent. And at that time, business, broadly speaking, thought their sales were going to go down significantly. Everyone had battened down the hatches and hide from COVID. And the exact opposite occurred. People couldn't go out. So if you look at Victoria, they were at home. They couldn't go out. They couldn't go on holidays. They couldn't do all these sorts of things. And so they sat at home and shopped online. And it created massive supply shortfalls. So you just saw the price of goods go through the roof. There was no sales activity. Then that morphed into, as supply chains started to normalise, and that took, a good 3 years, you got services inflation starting to kick in. So higher wages, you've got input cost pressures like, say, rent and electricity and all those other bits and pieces. So certainly supply chains are now normalised. We saw that in the most recent reporting season for Australian equities. But cost of doing business, for want of a better word, is elevated. And this is at the same time you've got no productivity gains from the labour force. So essentially inflation is stickier than what was originally expected. And that means rates were expected to roll off starting last year, but we think that's going to be a much slower thing and maybe not come back as far. We certainly think the RBA's pretty much done. You might see one more, and that's where, the recent spike in energy prices and things like that come through. You might see a little bit more from them, but certainly the bigger impact is not so much that potential one move up. It's more the fact that they won't come down as quickly as what was expected. So that all flows into bond yields, and bond yields I think they're the highest they've been in about 16 years. So again, if you've got defensive assets, you're getting paid reasonable income on those for the first time since probably pre-GFC, which is a long time ago. I'm showing my age here. So I was well into my career by then, but so we see the real issue domestically from an economics perspective. It's actually a demographic divide. So if you think about people who at peak spending years, they might have kids in school, they might have mortgage, they might have all these other expenses running. they're the demographics, say 25 to 50 odd. They're the ones that'll be feeling the pinch of higher rates, higher costs. Whereas if you think about your retirees, they're generating income off assets that have previously generated them next to nothing for a long period of time. So we've actually seen it in, I think it's CBA data. The spending of older generations is actually going up pretty significantly, whereas it's getting pinched at the younger demographics. So that's a major change. So this current environment benefits savers, not borrowers, and that's the inverse of what it's been for a very long time.
Yeah, definitely making things a lot more difficult for the people that are already feeling the cash flow pressure. So you talked a little bit around interest rates and potentially falling, and that's going to stick around for a lot longer. What are some of the expectations out there? Is there any relief for people in the next 12 months? Is there anything that's likely to happen from an interest rate perspective, or are we talking very long term in terms of rates likely to come down in the future?
Yeah, well, I mean, I don't think you're going to see much higher rates for a start, but it comes down to often markets move on expectations and changes of expectations as opposed to the actual underlying. And the expectation was they were going to roll off reasonably aggressively over the next sort of 12 months to 2 years. They still may well roll off a little bit, but not as much as what was expected. Hence the change in bond yields. We're of the view that you never really know until it happens, because ultimately, if you looked at the employment numbers yesterday, the unemployment rate went down again yesterday, even though the jobs created was quite low. Unemployment rate of 3.6% is very, very low. And so if you think about it, normally a recession, which is what would bring rates down, do you see a recession when there's an unemployment rate of 3.6%? And I'd argue you won't see that, especially at a time when you're also seeing very strong wages growth coming through. So our view is that the Australian consumer or the Australian working age population, it's more a function of they'll be forced to choose. They'll be forced to moderate their spending. So if you think back in COVID when interest rates were ultra low, you were getting exemptions from the tax office from your quarterlies. The banks, if you asked them, would defer your interest payments. At the same time, the government was handing out a lot of money. People could really spend what it is they liked, whereas that's not the case anymore. So if you get the consumer is forced to choose between, goods or holidays or whatever it is, it makes things more difficult than what it was. It doesn't mean we're going to go into a massive recession. So that's the thing, is that the labour market is proving to be very resilient. Economic activity is proving to be very resilient, which unfortunately means that rates will probably be higher than what they otherwise would have been. So it's a straight double-edged sword.
Yeah, I mean, that's a really interesting one because, we've been increasing interest rates in order to contain inflation, and those two things that you were describing go against that because they're inflationary in nature. Is it just a matter of the RBA keep doing what they're doing, meaning monitor the economy, and as and when the data presents itself, just continue to pull the lever on increasing interest rates if that's the way that the data goes? Or is there other mechanisms that they can look at in order to change that? Because it seems like what they've done is working, but it's probably not working well enough or as well as expected, because there are these outliers like what you had just described with things like the unemployment figures have been stronger than expected.
Well, you must remember the RBA hasn't gone as hard as other central banks. So the US, for example, their interest rate is well in advance of ours. So our RBA, I think, has been actually quite considered, and they're not expecting our inflation rate to get back within the target band until FY25. So they're trying to tread as gently as possible. So again, but that means that if inflation is worse than expected looking forward, they will have to lift rates a little bit further. They may also be slower to bring them back down again on the other side. So, it's a difficult one. I think, and I guess interest rates have gone up a lot from where they were, but they're really just back to something resembling normalcy, from pre-COVID basis. So, I think if looked at this ages ago, so the number might not be current, but I think the average mortgage rate over 30 years, and I might have done this sort of 5 or 6 years ago, was a bit over 7%. And that's probably, not too far from where it is now. So it's just that you're coming off an ultra low base. You're coming off, if you shopped around, you got sub 2%. So it's that recency bias. Interest rates have exploded. Well, they're actually gone back to where they were prior to. So the big issue there is property prices haven't really come back. So you're doing an average interest rate on a much larger capital value, on a lot more money. So, and again, we had no immigration through the COVID years. So essentially they're all coming in now. I think they're expecting a bit over 300,000 this year. Long-term average is sort of 160, I think it is. So again, you've got people coming in. That should ease the employment market a little bit if labour's coming in, but certainly it doesn't do too much for the housing side of things. So I think you'll see the central bank, the RBA, be very cautious. They won't want to cut too early because inflation just comes right back. I think they'll just stick to a reasonably conservative plan of bringing it back down to the target band over the next couple of years, and so you may see a little bit of relief going forward, but I wouldn't have thought you'd see too much because the economy is not terrible.
Yeah,
everyone's finding it difficult because the cost of things is going through the roof, but unemployment's low, wage growth coming through. It's just that the costs are going up faster than the wages is why everyone feels like they're getting pinched.
So I guess sort of and shameless plug to anyone that wants to sponsor us. Not talking about Qantas or anything like that, but soft landing. Everyone's been talking about that, and I'm kind of reading between the lines, Bruce. You're talking about economy strong. The RBA has sort of treaded quite reasonably well around interest rate movements and guiding the economy around driving down inflation but still keeping the wheel spinning. What's the likelihood? Where are you seeing things in that? Is it likely that we are actually going to be able to tread through this without too much turbulence in the economy?
Yeah, that's an interesting one. I mean, we're probably sitting on the side of, say, a mild recession is we're sitting, because we were talking about it before the podcast started, but through the most recent reporting season, the cost of doing business was a major impediment for companies. And when I say cost of doing business, it was labour costs, it was electricity costs, it was rental costs. It was their input cost pressures really starting to come through. And at the same time, you potentially have a soft demand because people don't have as much money to spend as what they did previously. Their cost of living is also gone up, so their discretionary spend money is less. So we think that companies, at the same time, you've got no productivity improvements out. Australia's productivity performance is absolutely terrible. So companies will have to tighten their belt. And how do they do that? They try and do more with less, usually. They can't really push through aggressive price increases of their product because ultimately they have done a great job of that during COVID, but at some stage that affects the amount of goods that people buy off you. So we think companies, and particularly the stronger ones, may price more aggressively in order to either maintain market share or gain market share, but that means lower margins. And at the same time, you've got input cost pressures. They'll have to try and lay those off, which means they'll have to try and do more with less. And so potentially you will see a weaker labour market. It's very strong at the moment, but if companies have to really tighten their belt to maintain profitability or even limit the downside to profitability, they will have to tighten their belt. And if you see a weaker labour market, things become a lot easier for the RBA. You might see a mild recession. If it blows out to, I think the RBA doesn't want to give away more than, say, 1% in employment. So if you saw unemployment rate at, say, the mid-4s, that's still historically a very, very good number. But again, the labour market's got no slack in it whatsoever. and for things to slow down, you need to see a little bit of slack there.
Yeah, no doubt, no doubt. Bruce, if we could just cast our mind overseas a little bit and talk about what's happening over there, just in terms of, you know, the different areas of the world, in particular, Middle East is getting a lot of attention now. There's, I guess, some concerns on potentially a greater conflict breaking out there. But in terms of what we're seeing and potentially what impact something like that could have on investment markets, and then we might roll in out of the back of that just in terms of portfolio construction, how you're thinking about that and how you guys are positioning your portfolios. But yeah, with the stuff that's happening overseas, how's that playing into all of the thinking around investment markets?
Yeah, well, there's a lot of impacts going on. I mean,
how long have you got?
First of all, you got, can the US find no one better than Joe Biden and Donald Trump for the presidency? There's 350 million people. Surely they can come up with two candidates that are superior to those two. So obviously the US's political system's broken. It has been forever. I mean, I think they've got real social issues over there as well between the have and the have-nots. But I mean, you can never really back against the US economy. So so that's the US. They're jacking up interest rates and their economy's still going pretty well. And probably the one thing to remember there is they don't have the sensitivity to interest rates that Australia do. You know, the majority, and when I say the majority, it's greater than 9% of their mortgages are 30-year fixed. So, you know, Australia being a variable interest rate country, when interest rates go up, people feel it, and that's not necessarily the same in the US. But so certainly the US politically is probably problematic. If you go to, you know, Russia, Ukraine has been a boon for Australia as an exporting nation. Pretty much everything Russia and Ukraine produce, Australia does as well. So if you look at agricultural prices, if you look at natural gas prices, all those sorts of things, Australia's terms of trade absolutely exploded on the back of Russia, Ukraine. That effect has sort of rolled off over time, but certainly if you're talking about the Middle East, you are talking about energy. If you see increases in energy prices, obviously that is a cost to not only individual households, but also to businesses as well. So you could certainly see inflation issues or cost issues on the back of that. The Middle East, I mean, is there ever a period where it's not unstable? But it seems worse now. I mean, but yeah, you'll just have to see how it rolls out. So, but it could certainly have an impact from an inflation perspective. If you looked at the UK is really struggling. No one talks about Brexit anymore, but that has hurt them. On top of that, their inflation, I think, don't quote me please, I think it got to around about 12%. And again, it's UK's not travelling very well. So Europe, I sound like an absolute Megatron, but Europe as a union's probably never really functioned the way they envisaged it when it was being planned out. So like there are a lot of issues globally. How it plays out into how we think about things is really more that you can't really afford to overpay for assets in this environment. If you think about going back to the US, its market has structurally changed. It's very much become a tech market. If you think about it that way, all the returns from the US has been from 7 stocks over the last 12 months. Yeah, that's right. So, whereas if you think about Europe, it's more an old school industrial economy. It's more a value. So it's almost a value versus growth mix. So how we look about things is really not overpaying. We think emerging markets is a reasonable proposition because they're further along the interest rate hiking cycle than what developed are. So you do have economies there starting to cut rates. Obviously, a really slow or a what's it called when it's a non-start of the Chinese opening. Obviously, China has an impact on not only global but particularly Asia as well. So, you know, they decided to reopen to COVID. Zero COVID policy was shelved, decided to reopen, and nothing really much happened. It didn't open up like they thought they would. So they will continue to stimulate, but the question is whether they stimulate in the way they've always done through infrastructure build and property and all those sorts of things. But they're trying to transform themselves into a services economy, and so the stimulus that they do will probably be different and more measured than what it has been historically. So we're not expecting a big bang from China. So in terms of how we're positioned from a multi perspective, we're slightly underweight the UK, probably at weight Europe, slightly underweight US on valuation grounds, and we're slightly underweight growth assets overall. And the reason for that is we don't think profit's going to fall off a cliff. We don't think you're going to have massive recessions or anything like that. But we think the combination of potentially softer demand combined with cost of doing business increasing is that margins will be more difficult. And so if you look at our forward earnings growth expectations, we think they are too high. Not by much, but they are too high. And they have wound back a little bit. But we just think that if you see forward growth expectations being wound back, that does go into multiples. So we think the multiples that you've been asked to pay for assets, and I'm talking very broadly, there's differences, massive differences between sectors. But we think multiples have room to come back a bit, and that's when we'll look to deploy the excess defensive assets that we have. Also, the other point is that we are overweight defensive assets, and you are getting paid to wait. So historically, you earn nothing on that. So if you're getting 5% on your defensive assets, you are being paid to wait. You are not, in our view, giving up much to be a little more defensive at the moment. Fixed income is a very difficult market at the moment. So you've got the two main branches. You've got credit, and credit is paying higher income than what interest rate securities are or government securities are. So if you think about a default cycle getting worse, credit might be a little more difficult. So the spreads might come in there and crimp your returns on credit. But if you think about duration, we are adding duration. So we're increasing our sensitivity to interest rates. We've been underweight for a long time, and it actually really helped us when interest rates went up. Interest rate securities had their worst period in, I think, 40 years through the interest rates going up, and we are now adding to that. So we think the central banks are towards the end of what they'll have to do. Eventually, you might see a little bit of easing, and that would benefit if you've got more duration than less. Getting the timing right on that, though, is difficult. So that's generally how we're positioned. We're overweight defensive assets versus growth. We're underweight more expensive markets than not, and we're lifting duration in the defensive assets because we don't think bond yields have that much further to go. If you think about the 10-year, they're at 16-year highs. They may go a little bit more, but we're just gradually adding to it over time.
Yeah. No, that's. I think that wraps it up very nicely in terms of what investors can do and how they can sort of think about putting together their portfolios and some insights around the global economy. So, Bruce, want to really thank you for jumping on the podcast. It's been awesome to have you on, get your insights, and Billy and I always learn a lot every time we speak to you. So I appreciate it very much.
Yeah, well, thank you very much. I mean, it's an interesting time. I don't think it ever pays to be massively negative, and I don't think any investors should be massively negative because fundamentally, I mean, even I was walking home from work the other night and there was a Flash ice cream shop down the road and there was a queue of 30 people waiting outside it. I mean, it must be good ice cream. Clearly, I look like I eat a lot, but I haven't actually considered that ice cream. But things are probably going to be a little more difficult, but not terrible. So it's just a constant adjustment process. But there are some big swing factors in play, and we think it'll probably roll out into a more difficult environment, but not terrible. So
cautiously optimistic.
Well, yeah, I think that's the way to position it. I mean, we're probably the most defensive we've been ever, I would suggest, from a tactical asset allocation perspective. But we're not terminally so. We're wanting to deploy, but we just think it's a little too early to do it. But again, when we do, it'll be a gradual process. So I don't think it ever pays to be massively bullish or massively bearish. It's just a gradual thing. And so I think things will be okay, if not a little more difficult.
Now, thank you, Bruce. Much appreciated as always. And to our listeners and our viewers, thank you for your time and attention. Don't forget to like and subscribe as always, and we'll catch you on the next one.
Thanks very much. Thanks, Bruce.
Thank you, guys.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.